it seems that there is a lot of interest in a lot of questions, we probably need more time for the debates afterwards. But the fact is that we have quite tight schedule until lunch. But after lunch we have one session, and which should end around 3 o'clock. But of course, if there is an interest for discussions to continue after that, then we are free to do that. So it's so if you cannot ask the questions right away due to the time limit what we have at the moment, then you can do that after the third session. Sorry. And actually, as we are quite tight with the time, then don't take it personally if I try to wave you who are presenting these ideas. But first of all, let me introduce you. Sorry about my pronunciation, but the name says it's Csaba Feher, who is senior economist of the International Monetary Fund, probably one of the best experts there on the pension systems, and he has worked on them heavily, past 15 years at least, in the IMF, World Bank, different positions in Hungary, and he is actually the man behind this seminar, or architect of that seminar, who has brought these experts together. So please, Csaba.
The objective of my short presentation is twofold. Partly to lay the groundwork for the presenters who come after me during this session, and partly to make some observations about the government's concept. But before going there, I would like to mention one more thing. There is a big question, in my head at least, that I have not seen answered in the government concept or otherwise, which is, what is the system that you would like to have in the future? You have to remember that the question of whether a pension system is funded, pay as you go, defined contribution or defined benefit, that's a technical question. The first question you have to decide, do you want a big system which does poverty alleviation and consumption smoothing, or you would like to have a smaller system which probably only does poverty alleviation? The way the Estonian pension system is currently going, including the expected benefits from the first pillar and the possible reduction of the second pillar, if things go along this path, then the Estonian pension system will be a small system. That's a legitimate policy choice. There is nothing wrong with it. But this choice has to be discussed openly. This should not be a policy choice that just happens, that suddenly people wake up to. So this was my first introductory remark. And I would like to continue with saying that structural reforms are matters of domestic policy making. We, internationals, we are just here to advise the government. We are not here to stop the government from doing whatever reform the government feels is necessary. However, I think everybody has to remember that reforms that are changes that are too frequent, changes that are not sufficiently explained, actually destroy faith and destroy trust in the system that is being reformed. And not only in that particular system. Once a major reform is reversed, the credibility of other major reforms may also suffer. So this does not argue against the government's plans. It simply argues for making sure that whatever changes are being considered are well-founded in analysis and are carefully explained to the population. I think it's also important that the answers the government is trying to find are actually relevant from the perspective of the questions. In other words, if you have a technical problem, then try to find a technical solution and not necessarily change policy, not necessarily change strategy. For example, if we believe that the poor investment returns or the high operating costs of the Estonian second pillar are technical issues that can be addressed through technical solutions, it might not be the best approach to to upend the whole apple cart straight away. Now again, this is not to argue against the government reform concept. Indeed, the Estonian second pillar does have problems, does have issues that need to be addressed. Question is this the only way to address them? Now, the main features of the proposal, I don't think I will talk much about because you certainly know it much better than I do. There are three aspects or three features that I would like to highlight, however. One is that at first sight, it appears to be a policy or ideological response to what, at least in my eyes, looks like a collection of technical problems. The second issue, the second feature, is that even if the role of the second pillar is much reduced, even if Estonia is left with only a voluntary funded pension pillar, the underlying problems are not being addressed by this particular proposal. The underlying problems which are behind high operating costs and relatively low returns. And the third observation I would like to make up front is that the concept is very heavily geared towards giving strong incentives for people to opt out. And although, as the minister also mentioned, there is an option of joining the system, but the incentives are not even-handed. This concept is clearly designed to downsize the second pillar, and we have to remember that there is a certain size below which the second pillar will just not be viable. Okay, good. Now, this I already mentioned. The first point, the proposal about being geared towards encouraging opting out. What I would also like to mention, I think this is more important, or probably the most important point from a pension policy perspective. Those of you who are familiar with the European Commission's Aging Working Group and the reports that are being published every 2-3 years will know that the projections about Estonia's first pillar, social security benefit ratios and replacement rates, place Estonia at the bottom of the table. So chances are that contributing less, saving less in a second pillar eventually will lead to inadequate pensions, inadequate total pensions. Now, this is obviously a welfare issue and a distributional issue as well. But it's also likely to become a fiscal risk later on. If average pensions, or pensions typically are low in a European country, chances are that the pressure to actually increase those pensions will be high, regardless of whether those higher pensions are being well-founded in past contributions. So this may become a fiscal risk. Last comment on this particular slide. I would like to remind you that the poorer a household is, the stronger the liquidity constraints. What it implies is that, if you give people a choice to opt out, to cash out their second pillar savings, and you also give them a choice to spend it or reinvest it or put it into their pillows, the poorer the household, the more likely it is that that money will be spent. So the people who will be hurt most in terms of their long-term perspective and in terms of their old age income security are the people who are probably the poorest. Now, a couple of more policy and technical issues. The way the concept is set up today creates competition between the first pillar and the second pillar. Because people are offered the choice to opt in and out, opt in and out. Now, this is not a fair competition, let's remember that. The state is the regulator and one of the competitors. There is no way the second pillar can win this competition. The other issue in this respect is that this quasi-competition gives all the wrong incentives, all the wrong fiscal incentives, all the wrong fiscal policy incentives to the government to promise more than what it may be able to eventually fulfill. And why? To make sure that more people switch out of the second pillar. Now, the proposal also assumes, and we have already heard about this before, that individual investors are superior to institutions in terms of their capacity to effectively place their savings. That's an assumption that is not borne out by either theory or practice. Yes, there may be some technologically and financially savvy Estonians, I'm sure there will be, who will go click on the right places, find a cheap brokerage, will be able to generate good returns. But that lucky few cases do not create a healthy social policy. They are just good examples. Most of the people who try to do this will not be successful, and we also have to remember that most people who will try to invest individually eventually will use the services of the same financial sector providers that some people might be unhappy about today. Parallel structures, that has been already mentioned several times. Voluntary payments into a voluntary scheme, voluntary payments into mandatory schemes. These parallel arrangements create regulatory arbitrage. They may increase costs. It only has drawbacks. So yes, indeed, if this is the direction the government wishes to go, then there may be a good reason to actually have just a single funded pension scheme. The uncertainty, and this has already been referred to before, the uncertainty regarding the switching out and cashing out and switching back creates such uncertainties that will limit private pension schemes' incentives to develop more risk-taking investment strategies, to invest more in their infrastructure. Also, a smaller market will be less able to reap the benefits of diversification. And last, there is a particular section in the concept that I've seen that I actually don't even understand, so I won't comment on it other than I don't understand it, which is that even annuity contracts that have already been written can be cashed out during the annuity payout phase somehow. I don't know how that works. So my concluding sentence is that while it is the government's legitimate prerogative to define pension policy, I think it would be useful to spend a little bit more time to better define and discuss, communicate the ultimate objectives of the reform, and to address some of the technical issues which can, as they stand now, can create chaos in the coming year or year and a half. Thank you.
Thank you very much. So we have next speaker you already know, Agnieszka Chłoń-Domińczak. She's director of the Institute of Statistics and Demography, Warsaw School of Economics. And she has held different positions related to social, labor, and family policies. She was Deputy Minister of Labor and Social Policy in Poland in 2008-2009, and was part of the team that designed and implemented the Polish pension system. Has consulted numerous activities related to pension reforms in the Central and Eastern Europe in cooperation with different international organizations. And as you can see, she will talk about reform reverses in Poland and Hungary. So, floor is yours.
Thank you very much. I will focus mainly on Poland. I think we have a couple of Hungarians at least here who can comment on Hungary as well, but I will do too. But for some of the issues, I will present you some of the discussions that we have on a pension system in Poland. Thank you very much for inviting me here. I think sharing our experiences and concerns, how pension systems evolve, how reforms that were introduced early in the late 1990s, in the beginning of century, in our region, it is very important to jointly discuss and think about the changes that are announced or are introduced in the context of the long-term sustainability of the pension systems. In fact, discussion on pension systems in our region is not something that just started. in Estonia or in Poland or Hungary, there's a cycle of pension system changes that started more or less with the economic transition, when majority of countries in our region realized that we need to reform our pension systems to break with the path dependency of the previous schemes that offered relatively generous benefits at relatively low ages in a different demographic context, with demography changing, much lower birth rates, changing of the economy and the labor market. There was definitely a need to change pension systems, and majority of our countries believe that we can break with the path dependency, introducing multi-pillar pension schemes. We also operated in a different environment that was way before we believed that we could join the European Union. Then majority of our countries in the region, including Poland, Hungary, and Estonia, we actually joined the European Union, and that also means that we needed to think about our pension systems in the context of the goals that are commonly embraced by the EU, that is adequacy, sustainability, and then the fiscal, financial, and economic crisis hit that also meant many changes to the pension systems. Part of them were temporary, part of them permanent, including the ones that introduced in Poland and Hungary. So pension systems operate in different contexts, and we need to look at them from the perspective of these various socioeconomic factors that affect current decision-making that we observe at least for the past couple of decades. So having this kind of a perspective is very important. So the reforms in our countries were actually, pension reforms accompanied the economic and social transformation that affected labor market, demographic development, and also pension systems, and as such that were more and more of a burden for the fiscal side. But also the population aging made us worry about what happens in the future. And that means that in many of our countries, we introduced reforms of multi-pillar system, but also rising retirement age, introducing closer link between contributions and benefits. Depending on the countries, we see quite a various mix of the pension system. This is just a very short summary of what happened in the region. Pension reforms were usually not only about introducing mandatory funded components, but also shifting retirement age, increasing and equalizing retirement age in many countries, also creating closer link between contributions and benefits, particularly in Latvia, Poland, where we have notional accounts, point system in Slovakia, and also reforms of the way pensions are calculated in the first pillar. There were different strategies on how funded components are introduced, whether there's a fixed contribution rate or rising contribution rates, what is the participation. But at the end of the day, those systems were introduced in countries in our region after EU accession and after the crisis. As you are pretty aware of, many of the countries, mainly because of the fiscal situation, which I will explain later on, decided to change the pension system, to modify, return to the dominant pay-as-you-go financing, typical for the Bismarckian systems. However, it's not a reversal as such, because the changes that were introduced in the pay-as-you-go system more or less remained. As you can see, there's a variety of ways how countries dealt with the pension reforms. Hungary did a permanent reversal. That means that the Hungarian government said all the assets from the funded system go back to the pay-as-you-go, and the entire future of pensioners relies on the pay-as-you-go system. In Poland, we reduced the contributions. We made the system voluntary with an opt-out option that was a default one, and basically all the assets are transferred back to the pay-as-you-go system before reaching retirement age. Right now we have the entire new ideas of what to do with the pension system, which I will tell you later on. There were also partial reductions of the funded components in Lithuania and in Latvia, in your neighboring countries, and also permanent reduction of contributions in Slovakia. So many of the countries did decide to downsize or withdraw from the mandatory funded schemes. So the question is it about the performance fees or fiscal issues? Some of these issues were already discussed before. If we look at the fees, that was pretty much discussed, they are indeed quite different between the countries. If we look at our region using the OECD estimates, we see that indeed Estonia had very high fees. We know that they've been reduced, but we also see that in other countries there were attempts to reduce reduce fees in those countries when they were pretty high. So high fees are not the reason why we should close down or reduce the size of the funded systems. They are rather an indication that indeed something needs to be done in order to reduce those fees if it is possible, also looking at the mandatory costs which are related to the funded systems, but also the profits of the pension fund companies. Is it about the returns? We discussed the returns in Estonia. This is the analysis that was done jointly by Kamila Bielawska, myself, and Darek Stańko. That's actually Darek analysis that shows comparable returns. This is by 2012, so 13. So this is not something which is very new. However, it is relevant in the context of the decisions of pension pension reform reversals that happened around 2012, 2013. I'm speaking about Poland and Hungary. So if you look at the chart here, actually Poland and Hungary were the only countries and Romania, but this was with the very short period of investments. In Hungary and Poland, with the the longest running pension systems, we actually observed much higher rate of returns compared to other countries in the region. Yet, these are the two countries that decided to go furthest with the reversals of their mandatory funded components. So that moves us to the issue of fiscal importance, and that includes the transition costs, which happen when we divert a part of a contribution to the mandatory system, and at the same time, we need to finance benefits that are paid from the pay-as-you-go system to the current pensioners. That means also that in the future, there will be lower fiscal burden related to the pension system that was mentioned in the previous session, but currently we need to pay those, we need to finance those transition costs. Reversals or reductions of contributions actually led to reduced transition costs, but as you can see, they tend to pick up in some of the countries, particularly in Estonia. We see that in the past years, the transition costs have been increasing, the same for Croatia, and this is also related to the way the participation is developing, as well as contribution rates that in some of the countries gradually go up. However, in Hungary, there are no transition costs anymore as the system was closed down. In Poland, as you can see, these were very low because very few people remained with their contributions in the funded system. Let me now move to how the transition costs were financed before and after the crisis. There are little triangles here, and the triangles actually contribute to Ardo Hansson, who's somewhere here on the who once drew a triangle saying that you can finance transition costs either from savings in the old age pension system, or from taxes burdening current taxpayers, or from the debt. So this is trying to fill Ardo Hansson triangle with figures before and after the crisis. So as you can see, what happened. Initially, the idea was that we will finance transition costs pretty uniquely in the region from trying to save on our pension systems, particularly in those countries that had high expenditure, on the current expenditure and current taxes, and maybe a little bit on the debt. As you can see here on the graph, yeah, the laser works out. This is the dead corner. So it's pretty crowded even before the transition. There were some countries that managed to actually finance some of bulk of the transition costs from taxes. Estonia is somewhere in the middle. Latvia was the most balanced as far as expenditure. But after the crisis, what happens is that the dead corner becomes even more crowded. So at the end of the day, what happened with the reforms is that its full financing went to the future debt, which wasn't the idea. But that also shows that pension reforms are actually a very long-term venture. So it's not only about thinking how we introduce those, going through the discussions, the laws, the parliament, but then it's a year-by-year implementation that requires sticking to the original path. The issue is that many of the countries didn't stick to individual path, increasing the pension expenditure, particularly before the elections, for example. Of course, the fiscal crisis was an external factor that also affected the possibilities to finance pension systems. How that affected the public finance? Again, we see that the crisis marked a very high increase in general government deficit. And that meant that the governments facing the fiscal pressure thought where we could find some money to finance increasing expenditure, also because of people losing their jobs, requiring assistance, and so on. So pension systems and the long-term objectives faced the need to sort of be foregone for the short-term necessities. In Hungary and Poland, assets were transferred back to the pay-as-you-go, to the public system. However, when we look at what happens to the general government debt, whether that contributed to a significant decline of the general government debt, Hungary is more or less currently at the level it was in 2008, Poland roughly the same 2008, 2009. So still the government debt is pretty high in most of the countries that decided to reverse. Estonia marks out definitely with regards to the level of the general government deficit and the general government debt, which is much lower compared to other countries in the region. So when we think about reversals in the region, except for Estonia, that was very much related to the fact that our fiscal situation was in much worse state, particularly in Hungary and to a large extent in Poland as well, because in our particular context, if the government debt exceeds the limit of 60% of GDP, the government needs to balance the government budget according to our constitution. So that's a very tough burden for the government. What happened to the assets? The assets of pension systems in the region grow slowly, as you can see in Estonia, Latvia, Lithuania, and the Slovak Republic, they gradually pick up with the implementation. There was a slowdown in the time of reductions after the fiscal crisis. Poland and Hungary, assets went up and then they stabilized. This is the voluntary part. In Poland, you see the huge drop. So basically, what happens to the financial market when assets drop down in such a significant manner, that's a huge question that I will try to give some answers. In other countries, assets are also growing slowly according to the needs. Some more insight on Poland. What happens with our pension system and pension funds after introduction of all of the changes? First, the way the Polish system is currently structured is that people who remained in the pension funds are those that needed to confirm their wish to be in a pension fund. So the default decision was that the contributions actually are fully paid into the pay-as-you-go system. So it is not like in Estonia where people will make their decisions either to stay or not to stay. The assumption was that people don't stay. If they want to stay, they have to say that. Very few people did so, around 2 million out of 11 people. So when you look at the contribution inflow, that was the third quarter of 2018, so this is the latest data published by our Financial Supervision Commission. You see that the inflow of contributions is very small. There is some fee, upfront fee from contributions and management fee, which are not very large, as you can see. Pension funds did pretty well in the third quarter, so they've earned interest. But then we also have a slider. That means that for people who are 10 years or less prior to retirement, part of their assets are withdrawn from and moved back to the pay-as-you-go. So at the end of the day, the net change of assets is mainly due to the fact that people have higher returns. The inflows from contributions are much lower than the outflows from the slider mechanism. What it means is that the pension funds in Poland are currently operating the system that is basically gradually liquidating. The inflows are lower than outflows. They have to manage the flow rather than thinking about how to invest money in the future for the benefits of the future pensioners. So the changes have consequences also for the pay-as-you-go parts and the pension systems. When we liquidate second pillar balances and transfer them to the state, it depends how the pay-as-you-go system regulates. If people are allowed to spend liquidated balances, that means that their pension wealth is reduced. So again, the question is whether it is compensated for in the pay-as-you-go system or actually not, because that means that the future systems might not deal with the compensation in an adequate manner. Again, going back to some of the research by myself, Kamila Bielawska, and Dariusz Stańko, here you can see that it actually depends very much on how the pay-as-you-go systems are designed. So, for example, the reduction or withdrawal of the contributions in Poland and Latvia, because the way how systems are designed with notional accounts means that there's a risk that the future pensions will be lower. Namely, the returns in the funded pillar are slightly higher than the projected increases in wages. That means that the returns from the funded are higher than the returns on the notional accounts, and the future pensions, because of that, might be lower, particularly for those that have longer years to till their pensions, as the accumulated difference would increase. In Slovakia, on the other hand, the way the design of the pay-as-you-go system means that the future pensions might be higher if the current system remains. So the change in pension wealth can actually very much depend on what is the interplay between the pay-as-you-go and funded. So we cannot really think about changing one system without considering what are the consequences for the other one in a short term, but also in a longer term. So that means that in the future, Slovakia will have much higher pension liabilities and more fiscal issues to consider. Poland and Latvia, on the other hand, will face the issue of adequacy of future pension benefits relying on the pension system. We've already discussed in the previous panel the issue of retirement age. I wanted to underline that changing the retirement age, adjusting the retirement age to life expectancy is something that happens in many of the countries. Raising retirement age is one of the important directions of reforms in our region. I will point out that Poland is again, unfortunately, an outlier with our government decision to lower the retirement age as of 2017 and go back to 65 and 60 for men and women. So the developments that we face in Central and Eastern Europe are subject to different socioeconomic conditions that we observe. Poor fiscal situation in many of the countries, not in Estonia, rising pressure from the current pension system expenditure, relying more and more on the future debt. But we can see that the performance of the pension funds didn't have a lot to do with reversal decisions. So in many countries, that was actually fiscal situations. And the reversals are made particularly in the countries with the highest demographic pressures, including Poland and Estonia, Poland and Hungary, where our fertility rates are very low, and the future of demography is even more gloomy than the one that we could see here in Estonia. Very quickly, because I'm running out of time, I would like to say that the Polish government, after the reversal, actually discusses what to do to reintroduce pension savings into the pension system. And that includes quasi-mandatory idea of employee capital plans that are introduced this year. That means that all employers will be obliged to establish employee capital plans for their workers, which will be auto-enrollment system with quasi-mandatory participation. That means that workers who do not wish to have an employee capital plan will have to withdraw from the systems, otherwise they will participate. Contributions to the system will be around 3.5%, financed jointly by employees and employers. They can be increased even more. So at the end of the day, that means that we closed down or almost closed down the funded component, and then we introduce another quasi-mandatory funded component, but at a higher cost for employees and employers. So the government realizes that we need additional savings, long-term savings in our economy to stimulate the capital market development that went pretty down with closing or reduction of the funded pillar. So at the end of the day, additional savings are needed. At the same time, the government announced that we will actually in Poland fully close down the funded system. However, we don't know the details of this operation yet because we are just before elections, and after elections, this change will happen. Okay, so at the end of the day, I would like to echo what Csaba said, that shifts in the pension systems should be strongly reviewed from the perspective of participants, financial markets, and the public finance system, also having this long-run perspective. The big question is it possible to remove inefficiencies of the existing systems, or is reversal or complete revamp of the system the best option? The most important issue is to sustain the public trust towards the pension system in the long run. If we destroy the public trust, no pension system will be able to operate. Thank you.
Thank you very much, Agnieszka. And our next speaker is Peter Holtzer, and he has headed two of the largest fund management companies in Hungary, currently the CEO at Oriens Investment Management, and he has been extensively involved in pension policy work in Hungary and internationally, also as a consultant to the World Bank. And he would talk about the questions about the regulatory issues. Okay, the floor is yours.
Yeah. Is my clock working here? Because it's... Or it's already finished, I'm not sure. 9 minutes. Oh, wow, 10, 11, 12. I think I have 20 or 20 or 15? 20. Okay, 20. Thank you. Now it's starting. Okay, thank you. Good morning. I'd like to start with maybe 3 remarks. The first is, given that I'm coming from Hungary, I've seen this movie before, which you're experiencing, and be careful. The second I wanted to say is that I'm very happy that Agnieszka finished with this new Polish approach, which they are just they have implemented, but they are just starting, because that's very important, and I'll return to this in a minute. And the third is I wanted to mention that the approach of this presentation is like, given what the minister said, a few minutes ago, which was, it's decided, guys. And you just tell me the details, but it's going to happen. This is the approach of this presentation. If we assume it happens, let's try to think about a couple of issues which are still important. And that's what Csaba mentioned in his introduction. Even if you sort of, kill off your second pillar, there are still important questions. And I'm trying to mention a couple of those, and then I think we will discuss it in the discussion part, and maybe also in the afternoon, because we are pretty sure that these are, essential questions. Oops. Yes. These are the topics. I'd like to talk a bit more about coverage. What happens when you have a mandatory system or you have a voluntary system? How many people are in the system? It's very important. And this is where I'm going to return to this auto-enrollment or quasi-mandatory system, which Agnieszka mentioned. I'm going to return to the delicate questions of the fees, market structure, and what's the reason, and also about investments. And I think we have to talk much more about default solutions. And this, if you like, our feeling is that maybe the biggest sort of philosophical question we hear here in Estonia is, how much freedom you want to give to the individuals. And at least I think my approach is a bit different from what we hear, is that, if we give all the freedom to the individuals, then the individuals will, have the best decisions. That's not the experience around the world. So that's why we would like to emphasize default solutions. Now, about coverage. On the slide, what you see, this is Central Eastern Europe. This is from a World Bank publication a few years ago. The red columns are mandatory systems. The blue columns are voluntary systems, starting from Poland, Kazakhstan, whatever, going down to Slovenia and Czech Republic and all that. There's Estonia somewhere in the middle. And what you see, this is compared to GDP, the savings compared to GDP. What you see in mandatory systems, you have, big systems. Where you only have voluntary systems, those are typically small. With 1 or 2 exceptions. So what you have to understand, if you go for a pure voluntary system, the coverage typically reaches like 10 to 20% of workers and not more. And this is all around Eastern Europe, all around Latin America, but even in the developed countries. So once you finish with a mandatory system and want only to rely on pure voluntary system, you save if you want to save. Most people will not save. And you have to think about that. And that's where this new idea, relatively new idea of auto-enrollment comes in, which is somewhere between a mandatory system and a voluntary system, which Agnieszka just mentioned. You are not compelled to save, but the default option is that you are in a saving system, and you may opt out if you want. So it's not an opt-in system, it's an opt-out system, and that's a huge difference. In these systems, and that's what you see on that chart, on the left you have the mandatory systems, and this is about coverage rates of working age population. So mandatory systems on the left, pure voluntary systems on the right. And in the middle, you have these auto-enrollment systems. So mandatory systems typically have like 90+% coverage. Pure voluntary systems have like 10-20%. And in the middle, these auto-enrollment quasi-voluntary systems may reach 60 to 80% coverage. And that's a good compromise if you don't want to compel people. You don't want to force them to save, but you make it easy for them to save. The typical, the first example in the world was in New Zealand, and now in recent years there was a big reform in the United Kingdom, and I think both reforms have been very successful. Many people rolled in or didn't opt out, and the coverage rate is high, as I mentioned, up to the 50, 60, 70%. I'm not going to get into detail on this chart, just to mention that in these systems, as I started with, it's very important to set default options very carefully, how much they contribute, what are the investment strategies, and all these issues are very essential. And I just want to return to two recent examples, because they are important. Poland, we will see. Poland is just starting, and Poland will be a big experience for all the countries in the region, including Estonia, including Hungary. Why? Because Poland, and I think Csaba mentioned, Agnieszka mentioned, and I also want to emphasize this trust issue, the confidence in the system. Once you have a system, and then a new government comes in and says, all right, we don't like the system and we kill off the system, but please go on saving. It's not that easy, because once people realize that a long-term contract, which they believed it's for 30, 40, 50, whatever years, just finishes within 2 months, I'm not sure they will be happy to start saving into a new system. And this will be a very interesting experience in Poland, because Poland has exactly this story. They had second pillar. They don't have second pillar now, and they want to tell people that here is a new system for you. Please stay in this system and don't opt out. We will see how they manage. But if they manage, that will be a positive feedback to all of our countries. Now in Turkey, they didn't manage. Turkey started about 2 years ago, and the opt-out rate is very high in Turkey. And I think there are at least 2 reasons for that. One is this confidence issue. They don't really like the government in Turkey, or at least many people don't like the government. And the other is that, unfortunately, in Turkey, they didn't catch the employer and told the employer, you must contribute. So in Turkey, unlike in many other countries, there's no employer contribution, only the employee. Now, without the employer, Agnieszka just mentioned that this is sort of an occupational structure. Without the employer, it's almost impossible to do it. So once you want to do such a structure, please concentrate on getting the employer involved. Now, back to the second point, the market structure issue. And this is very important, and we've not discussed it today yet at all. Unfortunately, the experience with practically all the Central Eastern European and Latin American pension reforms of the last 20, 30 years, including Estonia, Hungary, Poland, Chile, many other countries, is that the market structure is not the best. The market structure is too segmented. Just think about your own market. You have a small country, small economy, small investment market, but you have 5 pension providers and 20-some pension funds. I mean, that's just too segmented. And that makes, scale efficiency in administration, in many other things, too expensive, too high marketing costs. So many issues which make it more expensive. And also there's a lot of switching. I mean, someone mentioned earlier the 10% switching in a year. I mean, that's huge. That means a lot of problems in a system. And the other problem with this segmented market structure, what you will realize is that you sort of have an oligopoly. You have a number of asset managers. Here in Estonia, it's maybe like two big asset managers. In Hungary, we used to have 4. In Chile, they have 4. And it's not really a competitive market, I'm sorry to say. And that's what you see in fees, and that's what you also, in many cases, see in investments. I mean, one of the reasons why fees also in Estonia were like, 150 basis points for a long, long time is just, it's a too concentrated, too captive asset management market, and that's not the best solution. I will show you 3 charts very quickly, just to make you better understand the big differences which you may have in different structures. This is what we have here in our countries. You have pension funds. The pension funds individually contract with companies or individuals. They collect the money. They have all this administration stuff, and then they have, very typically, they have captive investment management. So the big pension funds use their own asset managers, their own mutual funds. They don't really outsource. They don't really go for the best asset managers in the world. And that, of course, influences gross returns. So it's before fees. It influences gross returns. The other end of the scale is the Swedish system. And you will hear from Ole about how they set up the Swedish second pillar, which is completely different. Because what they did in the Swedish system, they set up a central interface. It doesn't have to be a state-managed or state-owned institution, but if it's a central interface, and if the central interface makes three very important things, of which I will mention now 2. One is a completely centralized administration, collection, back office, reporting, everything completely centralized, and it makes it much, much cheaper. And the other is asset management selection. So what they do, it's not the asset managers who compete individually for these mandates, but there is a central interface. There's a system which is called the blind account system, which I'm pretty sure many of you know about, which means that the fund managers do not know the end client. They compete for institutional mandates of this central interface at a very low fee. And the third issue, which we may want to discuss later in the discussion phase, is the pension products, because there was a very relevant point earlier about, we don't really talk about pensions, and I agree. So the pension provision is also special in Sweden. And then what they have done in the UK, in their experience, is sort of a mixture of the two. They had the old system with the old pension funds, and then they introduced a new player, which is called the National Employment Savings Trust, the NEST. And the new player brought in efficiency. They collected a lot of new savers, and they work very cheaply, and they have also this default life cycle portfolio. That makes their investments much cheaper and much more professional than most of the market. Now, just to remind, and maybe it's just a quick reminder, this is a typical life cycle or target date portfolio, and I think we need to discuss it maybe later in a bit more detail. This is what tells you when you're young, you just want to save more in risky investments like equities. And when you're old, you want to save more in less risky investments like bonds. And we also heard before that investments for a long time or in a certain period were too conservative. Here also in Estonia, that's not good for long-term returns. We know it very well. Just to show you some illustration about fee levels. In the first block, you see some of these examples where they have this sort of market structure, which I just showed you, this Swedish or Kosovo very centralized, very efficient market structure, or NEST. In these countries, the fees may go down to somewhere between like 10 and 40 basis points altogether. I mean, we will hear about the Swedish example, which is like around 10 basis points. It's a very, very efficient system. So that's one block. And the other block, the second one, is where we talk about really huge pools, huge investment funds. And that's another example where fees may go down to 10, 20, 50 basis points. There was a remark before I think by Christian, who said that, the only way to minimize fees is if you have, big pools, asset pools. That's what I'm trying to show, that that's not the only way. The other important way is to make the whole market structure more efficient. It's very important to realize, in line with what I'm trying to say, there's no simple correlation between the number of fund managers and the level of fees. So it's not like, if you have 2 managers, then the market will be expensive, but if you have 10 fund managers who do compete a lot, then the market will be more efficient. It's not the way. Here you see, for example, countries like Bolivia with 2 fund managers is much cheaper than, say, Turkey or Hungary or other countries with, 10, 15, 20 fund managers. So there's not a simple solution. If you have more players, then there will be more competition. It's not the way. That's a long-term development of total fees as compared to assets in many countries. And you could easily put Estonia also in this map because it's very similar. It starts with high fees over assets when the assets are very small, and they tend to come down as assets grow, but then they tend to get stuck at around 1%, 1.5% for a long time. And that's exactly what you also had here in Estonia, and you have Poland and Hungary and all the other countries there. But down, the dark blue is Sweden, where, as I just showed, they started with a different structure, and from year 1, they already had fees around 80% going down to 50% and even lower. So it does make a big difference. Now, just very briefly, what we sort of understand of the Estonian experience is in line with this story. I would say that I don't really have a problem with the long-term portfolio structures. So what I found here is that the portfolio structures, which is a reasonable size of equity investments and the big international diversification, I think it's okay. It's good. So I don't think that any problem or most of the problems would come from the investments. However, if you look at the long-term net returns, they are really low. We can talk about the exact figures, but they are really low. And I think most of it really comes from the fees, and most of it, or at least a big portion of it, could be eliminated by a different structure in the future, which I'm talking about. Okay, so. This is one of the concluding slides where I try to summarize a few issues which are important also in the future as you go ahead. It's not enough to disclose performance because people will not understand, and I don't think price regulations are sufficient on their own, so a better market structure is also important. It's very important how you set up these investment-making entities, boards, they should be as independent from the government and from the individual market players as possible. If they depend on the government, then they are going to, invest a lot in government securities and all those issues which are important to the government's heart. If they are too close to individual market participants, asset managers, there may also have problems. So be they as independent as possible. The government structures are important. It's a good idea to have external directors and not only internal directors. It might be a good idea to have an involvement of international experts. It's very important, which I emphasized before, low-cost default solutions, and I'm pretty sure we will hear about the Swedish case in this respect. And just to remark the very last point, you should minimize switching, you should minimize early withdrawals because it just makes it more complicated and more expensive. Now, one key issue is what we hear is, leave more of the decisions to individual savers. And individual savers will make it better than what we've seen before. And Csaba already mentioned that, we have a questions about that, whether the individual savings vehicles will be efficient, whether they will not be too expensive, and how these individuals will behave. There was a very good question in the earlier session about the number of individual savings accounts. And I don't think that if you have only like 20,000 people who do invest on their own today, then, you know, millions will start investing in 2021. It's just not going to happen. And back to the financial literacy question, it's not going to happen. And this is not Estonia. I mean, even in the UK, the US, financial literacy is a key issue, and there's no way to solve it in a year or two. So we are not sure it's the best idea to leave it to the individual investors. And this is my concluding page. So if you don't have a mandatory second pillar anymore, what's your second best? And what we are trying to say is that this auto-enrollment approach might be a good idea. So think about it and talk about it, and maybe get to the point where Poland got after a few years, and maybe Hungary will, that it might be a good idea. Think about these automatic default solutions as compared to free choice and how individuals choose. Think about all the benefits of centralizing administration and centralizing a lot of things which is possible. Try to make asset managers compete on a centralized, institutional, wholesale fee, blind account basis, because that makes it more efficient, and the long-term returns will be better. Try to make the governance systems as professional, as transparent, as independent as possible, and try to minimize the early withdrawals, and try to keep, you know, the savings within the system, because that will generate more savings, and that will also make it more efficient and more sort of long-term oriented. And I will leave the rest for the discussion. Thank you very much.
Thank you very much. And we will continue with Dariusz Stańko. He's senior private pension expert in OECD and the head of the Secretariat for the International Organization of Pension Supervisors. And he has previously worked with pension policy issues in Poland in different capacities, including as advisor to the president and in academia. So the floor is yours, please.
Thank you very much. Thank you for inviting me. Thank you for inviting OECD to this extremely interesting and timely workshop. I've been asked here to present a couple of best practices. I'm not here to preach on you. What you are going to do is your own decision. The OECD is a place where we try to collect the experience from various developed countries, and we want to share the good things and bad things that happened. So the first part on the governance, obviously the issues with governance and the problems with governments are somehow similar and somehow different. The differences come very often from the way that the pension funds are structured. So simplifying, we can say we have like three very general types of pension funds. The institutional, which is kind of Western style or occupational pension in many countries. We have contractual, which is a very typical case for this our region, and we have trust fund, which is something in mainly Anglo-Saxon countries that have in Africa, for instance, as well. So we have typical governance challenges. One of the biggest is that competence and expertise of the body which is managing the fund and controlling the operations, and also checking whether these processes are proper. I would say that from the perspective of the institutional pension funds, this is less a problem, because the managers tend to be professional, they have to be licensed, they have to be scrutinized. Also in the context of markets like in the Eastern and Central Europe, usually the number of providers is not that big, so for the supervisor it's much easier to squeeze the quality out of the managers. But this is a big issue, for instance, in the trust-based systems where you have thousands, like in Ireland, you have still thousands of pension plans, and each of these plans is supposed to have trustees. Usually they are selected from different environments. Some of them are completely, let's say, new to the topic. The quality of risk management, internal controls, and managing scheme of administration, this is crucial in all the systems. Conflicts of interest in a way to be able to manage the conflicts of interest. I'm not saying that to get rid of conflicts, it's not possible. Conflicts of interest needs to be identified and properly managed. So, for instance, if there is a decision taken by a couple of people, if one of those persons see there is a conflict, needs to report it and probably withdraw from the decision taking. In the context of the Central and East European countries and also Latin America, the mandatory defined contribution pension funds, we have this something which we may call a vacuum of the membership governance. These are the professional funds, and as far as I understand, it's extremely difficult to set up some kind of representation of the pension fund members because they are coming from different companies. This is a mass-scale system, so it's also operational difficult to set up a representation of, let's say, 2 million pension fund members. But there have been some discussions that probably it would be advisable to consider whether to minimize a little bit the impact of the pension fund administrators as one side of the process, to minimize this potential conflict of interest that might occur in a way that there might be a preference for more active asset management rather than the passive, or there might be fees that ideally could have been reduced if there is a proper scrutinizing of the process. Again, this is probably not the very case of Estonia or our region. The governing bodies, sometimes they lack guidance, or they need the guidance from the regulators. It depends on the process, obviously. So this is something where the supervisors need to step in, and supervisors need to have resources to do that. And finally, the issue that has been already several times touched upon, the information, the quality of information and the understanding of information for the members. One thing is, obviously we can do a lot to secure that the information will be properly disclosed, it will be even digestible information, but you cannot work for somebody's brain to process this information. So you need to at least try to set up some processes where you can at least try to check whether the members properly identified the information, properly understood that, and then they can take the decision. The whole morning there was this kind of a little bit hidden discussion between the belief in people's brains and the liberty and the free market. That was something that I must say that 20 years ago when I was involved in pensions, I was also very much a believer that the competition should work fantastic and solve a lot of issues, maybe not all of them, but at least some of them. Obviously, this is not the case because of the people's limitations, but also because of the nature of our markets, the pension markets. Usually it's a heavily regulated oligopolistic style market, and you cannot even accuse the pension administrators they are oligopolistic because this is the effect of the market that you structured. We had some comments here that it can be changed, but this is kind of ex post. Now, as you might know, or maybe not, OECD has produced core principles of private pensions regulation, which were drafted in, I believe, in 2009, and they have been recently upgraded, revised to incorporate also the voluntary pension schemes. So when it comes to the governance issues, we have in the core principle 2, which is talking about how to establish pension plans and funds. We have a couple of statements that are very general by definition because there are not detailed instructions, but this is kind of summary of the common wisdom. So pension plans should be subject to governance requirement. Of course, those requirements should not be excessive, and the other requirements. There should be a legal and also physical separation of the assets between the pension fund and the manager. And there should be a governing body. There should be some fit and proper requirements for those who will be governing, managing assets. And there should be a functional separation between those who take the investment decisions and those who do the after investment processes like settlement and bookkeeping. Then there is a whole core principle on governance itself, which states that the pension funds pension fund managers or pension funds, to simplify, should be guided by the best interest principle, and equally important, they should make sure that the pension funds are in a proper sound position. There should be a division between the operational and oversight responsibilities. You cannot be a judge of your own case. There should be a clearly stated accountability and suitability of those who have these responsibilities. And of course, there should be a whole mechanism of controlling communication and structuring the decisions so that the decisions are made in a proper way, which includes, of course, the review controls, internal, external controls. There's a very detailed discussion on that in the document. When it comes to the investment strategy, pension funds, via its governing body, should be using the prudent approach. And sometimes it depends if it's a DB system, they should take into account the liability structure and duration. Now the management, from the perspective of investment management, we have the core principle 4, which is saying that the regulation should be requiring that in the investment policy statement, we have stated retirement income objectives, that there is a prudent person standard, which is dealing with, for instance, the issue of self-dealing. This type of transactions should be, if possible, avoided. Fiduciary duty and the investment process. And the investment policy statement should have several elements as listed here. I think that one of the things which is somehow linked to what has been saying is there's an encouragement to provide, whenever the members have the choice in the investment options, they should also have this kind of safety net as a default option. So if I don't know what to choose, or if I'm not sure how to choose, I can always take the default. With the portfolio limits, which I think is not the really case of Estonia, but in many countries, like in the organization that I'm working with, it is still the case that there are some minimum investment limits, and this is something that the OECD finds not really desirable. If there are limits, which is of course possible, they should not impede the diversification and risk management of the pension funds. Now coming to the fees, we have concluded as the International Organization of Pension Supervisors, which is kind of sister organization to OECD, because OECD is providing the secretariat. So we have concluded a study which was using both the data from the IOPS members and also those members who are IOPS members and OECD members, so that we had quite a big number of jurisdictions, 44 jurisdictions, and as you can see, mainly the fees are on assets, contributions, or performance fees. There are a couple of countries, like in Chile, where they're on the contributions, but surprise, surprise, in Chile, everybody thinks it's only the asset management fee, but there's also a fee charged on the assets, on the contribution fee, but there's also a fee which is not called fee, which is charged on the assets, and this is for the indirect management, and it's like 24 basis points, so it's also, sometimes what you see is not what you really think it is. Most of the schemes charged fees on one component, maybe not most, but 42%, which is quite a big chunk. I believe that this is one of the trends to increase the comparability for the members. If you have only one fee, it's much easier to choose between the different pension funds if you really want to choose. if you have 2 or 3, it is not that straightforward. So there is this tendency to not only to increase the transparency in terms of the information, but also to simplify the fee structure. And we can see that in the results here. As it has been said already, the fees tend to decrease because the assets under management are increasing. Because the regulators and policymakers are intervening by imposing some maximum limits, and because some people are also thinking about the relatively innovative structures like the auctions, which are currently in Chile, Peru, and New Zealand, which means that if there is a new generation, new cohort entering the labor market, this cohort will be serviced by the pension fund that offers the lowest fee. And of course, there are other cost disclosure requirements. So this is the study that I mentioned. It shows not only the current market values, but also the legal ceilings. And we also calculated a couple of indicators like charge ratios. What was interesting from the supervisor's point of view is that actually nobody really knows what are the substantial cost positions which are charged to the members, but which are not included in the fees. This is really difficult, and this is an area where you can improve, because basically you can follow one of the examples of the Netherlands, where the regulator gradually increased the level of information, the granularity of information on the fees, on the costs, and the pension funds had to disclose them more and more, which also resulted in much lower fees. The charge ratios for the most comprehensive clusters, we have a cluster here, countries which are more or less similar. They've been between 19 and 22% for the 40 years' time. Charge ratio is a kind of indicator showing how much your pension will be reduced as compared to the situation when you get all this service for free. So basically, your pension is on average 1/5 lower because you have to pay. But that's natural because this is a service. If there's a service, you need to pay for the service. The only issue is whether you pay a lot or whether you pay relatively reasonable fees. One quite interesting remark here is that we found that, maybe not surprisingly, that occupational pension schemes which are non-for-profit and those which are somehow linked to the employment tend to be much cheaper than the personal schemes. So that might be something that you need to digest in the context of the ideas how to create the pension system. As I mentioned, we have analyzed countries by clusters, showing whether it's all-inclusive or whether it's not all-inclusive. So if I pay, let's say, 2 or 3 types of fees, do I have also the indirect management covered by this fee? For instance, do I have the custodian bank already included in the fee, or do I have to pay that indirectly from my assets without even knowing that I'm paying as a member? So we have those 4 clusters, even 5. Estonia is not here, unfortunately, but we can do the calculations if you want. The average fee has been decreasing. This is something that has been already said. So as you can see, the fees is getting into the more or less the limits of the OECD members. Estonia is like within the 17 countries which charge less than 1%. For the investment, this is the way that OECD calculated the returns until the end of 2008. As you can see, the investment indeed was not better than the average by the Estonian pension funds. One of the reasons is, as it again has been already discussed, is that the Estonian pension funds has been following relatively conservative approach and also bad timing. So when there was a moment where you could recover after the crisis, you were actually quite conservative. So there is no much alternative investment yet, as far as I understand. And so if you compare the the returns with other countries. It has been already discussed in the morning. One of the reasons is the timing of the investment. Second is the conservative approach and not using the illiquidity premium. Then if we give people possibility to use their money, obviously it can create some issues because there are those psychological things. Therefore, automatic enrollment is something that we might be considering. Otherwise, we might have the inadequate pensions at the retirement. About the diversification, there was this discussion about the golden rule, whether the R as a return from the capital market is higher than G as the growth rate. This is something for the really fancy macroeconomists. I'm not macroeconomist, whether the golden rule of the relative scarcity of capital is met or not. I would say here is more important probably not whether funded pillar gives you more than the unfunded. It's more important to see the diversification in terms of different reaction to the shocks. So let's say we have the investment, we have a catastrophe at the financial market, the funded pillar goes down, but the pay-as-you-go pillar reacts with some kind of delay, and vice versa. If there is something happening to the unfunded pillar, you have like demographic risk, you can still go with your investment abroad and you can invest in the countries where their demographic structure is a little bit smaller, so it is some way of getting the migrants without getting the migrants physically. You just invest abroad and you participate in their economic growth. So when you will be considering, as it has been already said, some of the areas for the improvement could be the diversification of the assets, introduction of the life cycle as a defined, improving the fees and costs, or thinking about the industrial organization. And this is probably my last slide. So you could think about investment in alternative investments, infrastructure, foreign investment. You could try to further reduce the costs of the system. You could, if you think the system is not really viable to changes, maybe you could think about using some of the experience of Sweden that I believe will be dealt with Ole. So with that, I saved you 22 seconds. Thank you very much.
Thank you very much. And last but not least, we are glad that we have already heard about some hints about the Swedish experience, and now we have Ole Settergren here, who is director of the research department of the Swedish Pension Agency, and hopefully he will talk about the Swedish experience.
Thank you. It's always a pleasure to be in Estonia, a very short trip from Stockholm. It's me between you and lunch, so we will do this relatively quickly. We were presented, or Sweden was presented as what you call it, best example. I think that's due to low competition, actually. We have lots of issues in Sweden that we need to deal with. And perhaps it's not even true that we are best in any aspect. Just a brief overview, because it's presented as being second pillar, what I'm going to talk about. But I'm from a government agency, and we consider this funded scheme as part of the first pillar. It's legislated, it's compulsory, it's largely run by the organization I come from, the Swedish Pension Agency. And there are two components. This notional DC pension, which is the big part in the public earnings-related pension scheme. 16% of wages is mandatorily taken out of wage and paid into this pension plan. And the premium pension, as it's called, this funded part, is only 2.5%. And the relatively small size of the funded part in the first pillar is important to the structure of the product, I would say. And then there's also government tax-financed guaranteed levels in the public pension scheme. And second pillar, in Sweden, we are often referring to them as the occupational pensions. They are quasi-compulsory in the sense that they are collectively agreed between unions and employers. And if you are employed by a company or an organization that have chosen to be a member of these occupational schemes, you cannot opt out of it. So if you work there, you will be compulsory paying into those plans. And then there's voluntary pensions in Sweden, of course. However, since 2016, there's no tax incentives for private pensions any longer, which is a little bit peculiar. And just the size of it in terms of relation of percent of wage sum. 15% paid into the NDC private accounts, 2.5% of wage sum in the premium pensions. And you see that we pay out pay-as-you-go pensions, these NDC pensions, we pay out a little bit more than we have in contributions right now, and that's financed by drawing down the buffer funds that exists. And the payments from the premium pension is still very low relative to what's being paid in. It's only 0.5% of the wage sum being paid out. Occupational pensions, quite high contributions, 10.6% being paid in and 6.8% being paid out. So there's a large accumulation of resources within the occupational plans. And then the private pensions are being drawn down right now due to the lack of tax incentives there. And actually, so there's a total of 28% of wages is set off for earnings-related pensions in Sweden. It's a lot, but I think it's about where most OECD countries end up if you add all the contributions together. Pension liabilities and assets in percent of GDP. The pay-as-you-go pension plan has pension liability of 200% of GDP, 31% in assets, large buffer funds in that pay-as-you-go pension system. Premium pension liability, 26% of GDP. Assets are by definition equal to the liability, or the liability is rather equal to the assets. So there's no risk for anyone else than the participants in the scheme. If the value of assets change, the pension will change. And occupational pensions are largely, are both DB and DC, and just for simplicity, I set the assets equal to the liability. It's a little bit more difficult in that pillar. Okay, now I will only talk about the premium pension, these 2.5% of wage that is by mandatorily paid in by employers and on behalf of their employees. The legislators' arguments for this pre-funded public pension was, I would say, mainly ideological. It was decided in 1994, and there was an emphasis on individual choice and responsibility, and politicians at that time thought that this premium pension would facilitate such choice and responsibility. There were also economic arguments for this pre-funded pension. Since the pay-as-you-go part, the NDC scheme is dependent on the development of Swedish economy. Actually, the average wage is the main risk in the pay-as-go pension. It was considered, or actually, as you wanted this for ideological reasons, I would say there were findings that you could also have an economic argument that this would imply risk diversification if there were some investments on the capital market and you could diversify away from the Swedish economy. And of course, since the risks in the premium pension is higher than in the wage-indexed NDC scheme, there's also a higher expected return in the premium pension, and that's a main argument perhaps for having that plan. But the reason also for this pension plan that it ever came into existence is a political compromise, because the Swedish structural pension reform in 1994 was an agreement between the political left and the political right in Sweden, and the right, they demanded this fully funded part to agree on some other aspects of the pension plan that the left wanted. So this is very much a pragmatic compromise that is the reason for this plan. Some design features. It's an open system. Any usage fund in the EU cleared by financial supervisory authority can enter. And due to this open structure or super liberal structure, where the agency could hardly say no to a fund if they complied with their being a UCITS fund, some 800 funds are at present available within the scheme, offered by some 100 fund companies. Inactive insureds' contributions are invested in a default fund managed by a government agency. And the government, the Swedish Pension Agency, is acting as a unit-linked insurer and clearinghouse and cost cutter within this plan. And due to this feature, all communication or all official communication between insured is through the Swedish Pension Agency. As was explained by Peter, the funds normally do not know who has been investing in their fund. There are some exceptions to that, but they are not intended, those exceptions. All pensions are paid by the Swedish Pension Agency. We sell off fund shares and take the cash and pay them out to the insureds. So still, during the payout phase, the funds do not know who their customer is. Their customer is actually the Swedish Pension Agency. And all pensions are paid as variable life annuities. That implies that there may be high volatility, or high volatility is expected in the payment. They will follow the development of the market. Some experiences so far, coming into our 20th year in existence. This single insurer clearinghouse administration has worked well. At start, 2/3 of the population or active workers actually made a choice of fund. Activity has since declined, and now 50% of the insured and 60% of the capital are chosen actively. The rest of the capital are in the default fund. The return has been high, but volatile, so that's different from Estonia. We've had a very, very favorable, but on average, but volatile development. This volatility has not been criticized so much. I think Swedes are quite used to invest in the capital market and used to volatility, but more important than that is that the payments have so far been insignificant to most retirees. So the volatility, they've hardly experienced it. And during the pay-in phase, people do not seem to be so worried about the volatility. The rationality of this enormous choice, at least formally enormous choice, and the difficulty of choosing and aggressive marketing has been a constant political, administrative, and business headache and debate during these 20 years. And so far, 6 different government commissions have been set up to investigate different aspects of the premium pension. Quite few changes has been made, but this is being speeded up right now. In 2016, the Swedish Pension Agency detected large-scale fraud in a fund based in Malta. However, this fraud originated from Sweden. They chose Malta for reasons of having a weak finance regulation there. Very weak, actually. It's been a problem. And several funds have since then been closed, also funds that have been admitted by the Swedish Finance Regulatory Agency. So we were given new legislation and increased mandate to screen funds, and that is a process now being ongoing right now. This will reduce funds perhaps by some 200 funds, perhaps, or 300 funds. So there will be some 500 or 600 funds after this screening has been carried through. But also, these 2 decades have given us lots of experience that there is not fully rational behavior in premium pensions, how people choose. And now a government commission is working on a reform to make a government agency responsible for procuring fund managers rather than having this open system where we passively accept funds. Another experience is that the administration of pensions payouts have been working smoothly. There's been almost 0 problems there. However, we will, I think, experience problems when the size of premium pensions become noticeable for retirees, and the volatility will be felt. So, some numbers on the fees. Both the costs of the Swedish Pension Agency is taken out of the capital and the fund managers. And these costs have been falling somewhat, more or less constantly, and are now at a level of some 27 basis points total, both administrative costs from the agency and the funds. However, I still think that they are high, these costs. They should be lower, and we should be doing a better work to lower these costs and to make the scheme more efficient. As you can see, even the direction of these curves is such that you can understand that there's still more fees being paid out in absolute terms than all the time. The capital is growing faster than the fees in percent of capital is falling. You should compare, I think, the return in the premium pension scheme with the average wage development in Sweden. And up until 2014, actually, the return in the pay-as-you-go plan exceeded, on average, the return in the premium pension, but not so any longer. And perhaps this is more informative. This is an alternative and better, I would say, return measure. It's an average capital-weighted rate of return for all insureds up to different points in time from start in 2000. So the premium pension has, on average, returned nominally 6%, and inflation in Sweden has been 1% during this, 1% per year. And the wage-indexed NDC scheme has had a return of roughly 3%. Of course, if you have an option of 800 funds, you will have different returns for different insureds. And this is a little bit perhaps strange that if you have return here, also this annual capital weighted return measure. And these are chosen funds, the orange here, and these are the number of insureds. And this is the default fund. The reason why you have this distribution of return in the default fund is that if you enter in different periods here, you will get a different average annual capital weighted return. But you can see that the return in the default fund has been significantly higher than those of the chosen funds. This makes it a little bit difficult also to explain why you should make a choice and why the legislature offers a lot of choice when you're better off being in the default fund. It's not so rational perhaps, but you should remember that it was a political initiative trying to sort of privatize part of public pensions, and having a big government-run default fund in a sense has nationalized that privatization. So it's not all politicians that are that happy with this large and very successful default fund. And one of the reasons why it's so successful is that they've taken much more risk than the private funds are actually allowed to take. They have chosen a structure where they are more than 100% invested in equity, because they gear up by lending money and investing it in equity. And the rationale behind this is that the people in the fund are so young still. They have a long period until they become retired. So this could be a good strategy, but a strategy that has not been open to those private funds in the scheme. Thank you. That was all.
Thank you very much. And actually, Ole was wrong in stating that he was between the lunch. Actually, we hope still to have some time for the discussion at least. I think we are slightly more than a little bit behind the schedule, but I think we can still snap some 20 minutes now and for the discussion. Hopefully, I heard that you're eating lunch very quickly, so I still expect you'll be back here 11:30 sharp. But yeah, do you have any questions from the audience? I see a lot, but maybe Martti first.
Martti Randver, Bank of Estonia. I have two questions. First to Agnieszka. You showed that after the reform reversal in Poland and Hungary, the size of the second pillar pension funds dropped very much, obviously. So could you please comment how this has affected the financial sector in Poland and also the financing of the economy in Poland? And maybe you can offer some comments also about the situation in Hungary. And the second question, more broader, is that when looking back at these two episodes of pension reform reversals, that ex post, is it possible to devise some safeguards, maybe legal safeguards, to not to eliminate but to reduce the possibility of these types of reforms? Thank you.
Thanks a lot. I think we gather a few questions before we start to answer. Yeah, back there, Lauri.
Yes, I have two questions. The first one is a bit more serious, and the second is a bit tongue-in-cheek. In the 1990s, there was high enthusiasm about second pillars across the region in Central and Eastern Europe. Although, even at that time, obviously the controversies surrounding the mandatory second pillar were quite well known. And there have always been both political parties, at that time more on the political left, and also scholars who have been arguing strongly against the mandatory second pillar. But overall, there was a prevailing high enthusiasm about the second pillar. Now, of course, with the reversal of these reforms in a number of countries, a question arises, yes, what went wrong? And Agnieszka addressed these issues in her presentation, but my question is more, could it be that the specific design of the second pillar, which was chosen by most of the countries in Central and Eastern Europe, and in particular the individual savings scheme, that could it be that it was an overestimation of the risk associated with the individual savings schemes? Both from the participant side that, if I may say it boldly, that perhaps the design overestimates the financial literacy and the competencies of scheme participants, and also from the institutional side that there is no counterpart effectively balancing the political risks. And what leads to ask me in this way is that we don't hear about possible reversals of those reforms from countries like Switzerland, Netherlands, Denmark or Finland, which also have a funded second pillar, but with a very different institutional setup. And the second question, which is tongue-in-cheek,
shortly, please.
Tongue-in-cheek, is that yes, you know that Estonians have always been very innovative, and when they introduced the second pillar, there was some innovative elements, how the Estonian reform differed from other countries in the region. And now, once Estonians are debating the reversal of the reform, there is again an innovative element which neither Poland nor Hungary have attempted. It is the idea of early withdrawal and sort of before the pension age. Poland and Hungary opted for the switching back to the first pillar. And could you comment on this Estonian innovation?
Okay, I'm sorry about there are a lot of more questions, but maybe I take three more, then Rasmus, then Andre, and then Andres.
Thank you. Rasmus from Luminar. I have a really short question. That you have all now looked into this, our reform. That if you now go back and somebody asked that, what is this problem, what they are solving here, that could you just describe in a few sentences at one moment of time? Thanks.
Thank you. Andre, please.
Thank you for this very interesting discussion. At the EBRD, we believe that there is a strong correlation between economic development and capital markets, in particular in terms of innovation, competitiveness, and resilience to the crisis. And what we have seen is that existence of the domestic institutional investor base is crucially important to the capital market and therefore also to the macroeconomic development. You will not find portfolio investors abroad coming to the country where there are no institutional investors domestically. My question is, does that resonate with any of the speakers?
Thank you, and Andres.
Yes, thank you very much, Andres Sutt from Riigikogu once more. I have a simple question. You have wealth of experience here. Could you please list the number of countries by name which have reversed the system from mandatory contributions or a funded pension system and went back to pay-as-you-go system in a country where population is aging? If there are such success stories, would be very pleased to know. Thank you.
Thank you, and last, Christian, please.
Yeah, thank you. I was really intrigued by the comment that an average person has lower rate of return than institutional funds. So my question is, should we tax the average person more, meaning that we should send higher percentage of our GDP to those funds, and in a couple of years we could see that the returns from those funds proportionally outweigh our wage growth, and basically everyone could leave their day jobs and live off dividends, the whole country? Thank you.
Okay, so we got a bunch of questions. We don't have too much time, but maybe everyone get at least try to answer what he feels suited to him first. Csaba, please.
I wouldn't want to talk about Hungary or Poland.
Okay, consequences on the financial market in Poland. So first, our domestic institutional investors became much weaker. So this is also reflecting on, and that is a pity, because we were more exposed to what external investors are doing in our country. Definitely we had a problem with primary sales, because there were no investors that were interested in buying equities of the privatized companies. Our stock exchange basically almost collapsed, and it was one of the most developing in the region, because there were no investors that were wanting to buy the Polish equity. So altogether, for the financial market and for the savings rate in Poland, the reversal of the funded system was a complete disaster. So that's why the government currently is thinking about this employee capital plan to sort of boost savings and boost investments and go back to the previous, almost previous status quo, but at a higher taxation of employers and employees. So definitely the financial sector in Poland suffered because of the reversal. I think Peter will tell about Hungary, he knows. But it is basically the same. So there's a price tag attached to the reversal. Are there safeguards? Ex post, I think it's very difficult. The only safeguard is democracy, and I think financial literacy of people who are listened to and they have a voice. It's very difficult in our countries again, because development of financial market and savings is relatively new given the history that we have before, and trust to financial markets just started to be built, and then it was to a certain extent destroyed by the reversal decisions that I think unanimously we explained in the panel. I think, again, ex post, probably there are many design issues that I believe we should have done differently. And Swedish example is one of the good examples of how to keep the costs, how to think about investment, how to balance the system. Also, I think we were overly optimistic with the distribution between the pay-as-you-go and the funded component. So ex post, things could have been done differently. Whether the things that didn't work could be improved, probably yes. So the reversals were not the only solution to the problem, but politically speaking, they were the most attractive because of the fiscal tensions that were discussed. The liquidation and withdrawal is definitely an innovative element, and it probably will have consequences for the level of pension wealth that we discussed. Again, the question is how the pay-as-you-go system will be designed to compensate for that. And from my perspective, I mainly look at the pension system. So the most important thing is to ensure that the future pensions are indeed adequate, and the old age poverty is reduced by either providing benefits or providing a system that incentivizes old age pension savings, but also provides ways how people can use their savings to actually finance their annuities and pensions rather than spending, because then at the end of the day, when people are in their 80s, which will be a case for many people, they will have lower pension income. What is the problem solved? I don't know. I mean, I don't think it's for us to answer this question, but I don't think I've heard the problem being explicitly said. So that's the crucial question. What is the problem and how it can be solved? So I think it's still an issue that needs to be. Should we tax people more or less? Again, this is a very important issue with regards to financial literacy, the behavior of people, the extent to which the pension system is actually an instrument of consumption smoothing in their life course. So depending on the choices, people should be either taxed more or less. There's no simple answer. Some people prefer to have more tax and better consumption smoothing through the pension system. If we look at many of the countries, contributions to the social security are pretty high, but people trust the pension system and they know that they will have higher incomes. I mean, if you take Sweden, 30%, almost 30% of contribution on incomes that finances purely old age pensions is pretty high, but still I think it's explainable given the transfers that people get. So again, that's the issue to discuss. What should be the balance between the contributions and taxes and consumption smoothing inherent to the pension system?
Okay. Any others want to comment on some of the questions? Yes, Peter?
Okay, so what Agnieszka mentioned about Poland is very similar in the Hungarian case regarding domestic institutional investors, regarding markets. One difference here, obviously, that you don't have a problem with state debt financing, unlike Poland and Hungary, where we did have, but yes, of course, it influences a lot the domestic stock exchange once you make these steps. So yeah, obviously. Back to the safeguard question. I mean, I don't think there is a safeguard. Agnieszka mentioned two items, democracy and financial literature. So that's why I don't think there is such thing as a safeguard. So you can always demolish such an institution. I don't think there is any way to stop it. Now, yeah, what was different? I think in the 1980s, 1990s, I mean, the world was completely different. So, of course, we are very, clever today, but then all these institutions and governments much more believed in if you like, the Washington consensus. Freedom, happiness, free markets, liberal institutions, and that's how these new markets were created. It's interesting to read World Bank literature. I mean, the issue which I was trying to talk about, this design market structure issue, started to appear in World Bank documents about 10 years ago, 8-10 years ago. So already about that time, they started to realize that, already the Chilean system is not efficient, and all the Eastern European systems which were based on the Chilean experience are not efficient. So that's the reason why we sort of come back and try to talk about the other options, like the Swedish option. Yeah. One other thing which I wanted to emphasize, and maybe it wasn't emphasized enough by Ole about the Swedish experience. I mean, come on, guys. Sweden worked on the reform for about 10 years. I mean, it does make a difference that you have the time to think about it. In Hungary, making the reform in the 90s, it was like 2 years, and the reversal was like 2 months. In your case, I'm not sure it will be 2 months. So it takes time to think about these issues. There are many, many, difficult issues, and it takes time to reach those compromises you mentioned between left and right and all that. I mean, if I remember correctly, the Swedish reform was accepted by 90+% of the parliament. 85, all right. In the Hungarian case, it was around 50, not much more than 50. I'm not sure how it was in Poland, but you need a large degree of agreement, because otherwise, it's just going to disappear. Yeah, I just wanted the last item I wanted to return to is this, early withdrawal of the money, which, once, and I think we will return to it in the afternoon. If you have an option to make this whole story in a way that, not too much money disappears from your pension funds, it's better. Because just what Agnieszka mentioned, I mean, you will need this money for long-term pensions, wherever it comes from, first pillar or second pillar, whatever. Pensions are already, not too high in this country, and if people just spend it today, it's going to be even worse. So I'm not sure I agree with this, very easy early withdrawal option.
Thank you. Ole, you want to?
Well, just to comment on Peter, and that's more sort of some opinions. I agree completely that the quality of legislation is very important, and also the quality of the administration. And both those quality aspects are heavily dependent on how much time you put into the process. And revolutions are always bad. So you should not do revolutions in pensions. You should, and if in Sweden there was a small revolution, but at least it went slowly. And some of the aspects of the Swedish experience are, you can make good lessons from not doing what Sweden did in many aspects also. So that were some opinions. And then there were some questions here, if I understood it correctly, from the young man in beard. I think if I understood you correctly, you think that if we expect the return on capital to in eternity be higher than wage development, we will have only capital in the economy and very low wages. Actually, when I was working on the Swedish pension reform in the early 1990s, this was also the conceived opinion that in the long run, wages and capital would develop similarly in the long run, and it was referred to as a golden rule. But it broke down quite rapidly, and then the conceived wisdom, as I understand it, and I hope there are better economists here than I am, if you don't reinvest the capital return, you can expect capital return to be higher than wage development in eternity without having any change in the size of capital and wages, relative sizes in the economy. That's at least what I've sort of figured now. And now we assume capital return to be higher in eternity in when we do our projections. It might turn out to be wrong, but that's what we do. And then there was another question whether we could list all the countries where we had transfer from funded to pay-as-you-go. I think I can't give you the list, but it's the direction very many pension schemes go in the long run, and very many pay-as-you-go pension plans around the world are the ruin of a funded pension plan.
Okay, I'm sorry, but with that I have to conclude now. But